A man who views the world the same at age 50 as he did at age 20 has wasted 30 years of his life. Muhammad Ali.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the retirement answer man, Roger Whitney.
In March of 1990, my mother passed away from cancer. She was 48, I was 23, and I inherited about $14,000. Now, I was getting married in October of that year to my lovely wife, Shauna, who I'm still married to today. So I took a little bit of that money, put it aside for the honeymoon, and then I took the rest of it and opened up an account with an advisor and bought my first investments. I think I bought Philip Morris at the time, a mutual fund, and Euro Disney. That was my flyer because I figured, hey, Disney's opening up in Europe. I think it was that year. I was like, sounds like a investment of a lifetime. I don't think it worked out that way. Anyway, since that time, since my first investment, probably just like you, I diligently invested in my 401k and in IRAs and some real estate and just took the cream off the top of our income when we had excess income and invested for the future, invested for quote unquote retirement. We were in the accumulation stage and have been in the accumulation stage, probably a lot like you, for decades now. That has always been my mindset. I'm accumulating for the future. Now at age 50, I am still accumulating, but it's getting closer to the time that we're going to need that money to do something for us other than just grow over the quote unquote long term. Now for me, I plan on working for at least another 20 years, but if you are close to retirement or in retirement, it's important to understand that accumulation investment mentality where it was easy to be loosey-goosey with risk because you have been throwing money at it over and over again. It's easy to just always bet on the long term. What got you to where you are today from an investment mindset likely will not get you where you want to go if you're entering retirement and trying to switch from the accumulation stage to making that wealth work for you. And unfortunately, most advisors are amazing at the accumulation stage. They're very good at helping you accumulate assets. Very few specialize in helping you turn that wealth on and have it work for you. So what we're starting today is, I haven't decided yet, it's going to be maybe a 5, 6, 7 episode series on learning how to invest in a much more prudent, disciplined way, focused on getting your wealth that you've created to start working for you. Because if you're near retirement or in retirement, you're transitioning from that accumulation stage, which is probably your only investment experience, to a very important stage of getting that wealth to work for you. And you can't mess that up. You really don't want to mess that up. So we're going to start this series today with a great discussion with one of my favorite people, David Stein, host of the podcast, one of my favorite podcasts, Money for the Rest of Us. And we're going to talk about the difference between gambling, speculating, and investing. But before we do that, we need the all-important disclaimer. Time for that all-important disclaimer. Now, this is important because we're going to be talking about indexes and investing and things like that. And I realize you cannot invest in an index. It is just simply a mathematical representation. And different types of investments have lots of different types of risks and attributes to them. And you got to make sure that you are investing in the ones that are right for you. So don't take advice from me on the show. This is helpful hints and education. Before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor, because that's just common sense. Now, I got a great little tool that a buddy told me about that we're going to talk about in the Hot Topic segment. Welcome to the Hot Topic segment, where today we're going to talk about your internet experience. My guess is you likely are on the internet looking at something probably right this second or every single day, multiple times a day. And ads are the revenue generator that allow you to have quote unquote free internet access, much like traditional TV, the advertisements, commercials pay for the programming. That's how you get to watch it for free. And it's amazing, me being a little bit of an Amazon addict. Maybe that's a new term, Amazon addict. Maybe we'll have a show on that. This is something I battle a little bit. It's funny now because we live in Dallas-Fort Worth and there's a big Amazon delivery center here. So I get a lot of things that can be delivered same day. And I've been testing, okay, if I order it at 11:30, can they get it here same day? Then I'll try. Okay, what about 1 o'clock in the afternoon? Can they still get it here the same day? It's crazy because I'm just so impressed with how the logistics that this company can run. Anyway, if you browse a product on Amazon or somewhere else, maybe you've noticed this, maybe you haven't, all of a sudden that product, let's say it's a pair of gloves, all of a sudden that product will show up in ads all over the internet as you surf because they know how to track your history. And if you looked at this pair of gloves, oh, he must like those gloves. So they keep popping them up around you to try to get you to click back to them. Trust me, it is a science. Plus, when you're on MarketWatch.com or Yahoo Finance or whatever else, there are ads all over the place. Okay, Roger, get to the point. So I'm talking to a good friend of mine, Nathaniel, yesterday, who is a pretty cool guy. And we're talking about rationalizing a lot of the technology tools I have. And he was helping me with some free consulting. Thank you, Nathaniel. And we get talking about the internet, and he tells me about this little add-on called Adblock. One word, Adblock, which is a little widget that you can add on to my Google Chrome browser, which is what I use on my Mac. And what Adblock will do is it will automatically block ads on the internet sites that you look at. So I just installed this yesterday. So as an example, I'm sitting here on the homepage of Yahoo Finance because that's what I use to track a lot of the investments that I pay attention to. And Adblock tells you how many ads it is blocking. So right now on this homepage of Yahoo Finance, it says it is blocking 44 ads on this page. Meaning it's cleaned up my internet experience so I don't have to deal with the clutter of all the advertisements and see the things that I want to see. So it's called Adblock, Adblock, and it's a widget for Google Chrome, and I imagine it works for other browsers. So you Google that, you get it in there, and then your internet experience is probably going to be a lot crisper, and it might save you some money by not clicking on that clickbait and going buying those gloves that you were looking at on Amazon. Now back to investing with a talk with David Stein, one of my favorite guys. So kicking off this multi-episode extravaganza about investing prudently for retirement, because you can't afford to invest by intuition anymore, I thought it'd be great to start with one of the most prudent, thoughtful men I know, David Stein, who is the host of Money for the Rest of Us podcast, one of my favorite podcasts. So let's have a discussion with David about what's the difference between gambling, speculating, and investing. David, how you doing today?
I'm great. Thanks for having me.
Good. This is a good time to have you on the show. One, because in my practice, I don't want to say building, because I'm just tweaking my due diligence process for managing client assets. And you've spent decades advising institutions and universities on asset allocation policy. So I think this is a great time to have you on. And plus, you're a pretty cool guy.
Well, thanks. Yeah. I'm not that old. I didn't advise for decades. I advised for about 15 years and then retired.
It just felt like decades.
It sounds good, though. Well, what's interesting, because I ran into this as we would have investment managers come and present to these college investment committees. And it was sort of, there's always a fine line because sometimes a manager would come and say, well, I've had 35 years of experience managing money. And the first question that would come to an investment committee member's mind is, when are you going to retire and what's your succession plan? So it's sort of like a sweet spot. You can't have too much experience because then people think you're not going to stick around, but you have too little, then it's like, well, you haven't been through the market cycles. So
exactly.
And I don't know what the right number is. So. But decade sounds like close to retired. But then again, I guess I am. So.
Yeah, you are, right? Sort of, kind of. So you said something that I'll just touch on real quick about having presentations from investment managers. Because like you, I sit in, whether it's private equity presentations for private real estate or businesses or investment managers. You go into a room, they give you this big deck, and then they make the case of why this strategy works. And I've sat through probably thousands of them, and you have as well. And they all sound great when you're listening to them, don't they? They all make
they do. Yeah. They do. And in the specific context that I was talking about, like we did that as our firm, and we met with managers all the time and went to their shops and kicked the tires, et cetera. But I was talking about a specific setting where you might bring in three or usually three is the best. And then like you have a committee that's never met this manager. So they're blind. So this is the first time they've seen him. We've sent them some preview materials and they have nothing to base it on. And it's amazing how this is set up. Is big endowments will often make a decision to hire somebody based on their presentation skills. I've seen managers lose because they couldn't present, and you see managers win because they could present well.
Yeah, not that they're necessarily the most skilled or have the best track record or whatever the matrix is. But what I want to talk about today with you, because I think this is a central problem or issue that everybody faces, not just individuals that listen to the show, but even professionals, of the difference between investing to work towards something you actually care about in life, speculating, which a lot of people mask as investing and being proactive, and then just simply gambling. Because those are three different things, and I think we get those mixed up a lot when we're making investment decisions. So what's your perspective on that?
Well, I do. And my definition, and I admit I got this from, and now I'm not going to remember the name of the professor. This was a gentleman that put together an education piece. He was based in Australia. I think he was working for the Australian Financial Authority, specifically trying to counteract what was going on in the binary option market, which we don't have to get into, but that is definitely a form of gambling. And I loved his definition because he said investing is when there is a positive expected return. And that is typically what we would have for traditional investments. So statistically, the expected return is positive. And usually those are something that has some cash flow. So it could be stocks, it could be bonds, it could be real estate, where the benefit of having cash flow is you can value it. So here's the cash flow. You can discount it back. We think it's worth this. Is it fairly valued? Is it overvalued? Is it undervalued? So that's traditionally when we talk about investing. Speculating would be where there's some disagreement on whether the expected return is positive or negative. And probably the best example I can think of is gold. Gold has no cash flow, and there's some disagreement at any given time what it should be worth. Now, I think most investors should have investments, and they should also, for diversification standpoint, have some speculation in the portfolio where there's some disagreement, because I think gold is a great hedge, gold coins. But there is no cash flow, and there's some general disagreement on what it should be worth at any given time. Now, gambling is where there's an expected negative return. Well, you're going to lose money. And so why would people gamble? Well, I don't know if you gamble, Roger, but people that go to Las Vegas, they're there. Yeah, they like to win, but they're there for the entertainment. And so a gamble is it's the entertainment value, be it the lottery or something along those lines. Where one has to be very cautious is where a gamble is, like Las Vegas, pretty straightforward, right? Everybody knows it's a gamble. You know that the house is going to win. Otherwise, Las Vegas wouldn't exist. So you're there for the entertainment. But if there's an investment or something that is supposedly in quotes an investment, but it's really a gamble, and that's where you need to be wary. And so that's why, as you mentioned, due diligence is important to understand, what are the dynamics of a particular security or investment to see, where does it fall? Is it really an investment? Does it have an expected positive return? Is it a speculation where there's some disagreement on what the return should be, positive or negative? Or is it really have an expected negative return, in which case it's gambling?
Well, let's go back to that investing definition because I want to get some clarification. So let's take, does it have to have positive cash flow in the form of, say, dividends? So, or is it from a reasonable historical expectation of how the asset class might act? Because I think of, say, many large quality companies don't pay dividends. So from the definition you gave me, those would always be speculations, not investing. So how does that?
They have earnings, hopefully, eventually, and they have cash flow. They have the promise of future cash flow that you can say, all right, I know that it doesn't pay a dividend now, but I can see the earnings growth. I can put a multiple in terms of a price to earnings ratio on that earnings and come up with a value.
Okay,
right?
so it's
based
not
on future expectation, but there's something meaningful happening with the business or the investment that you can reasonably statistically say it has an expected return. Okay. Now, I mean, there's some disagreement. Some people could say gold is an investment because it's always gone up over time. But at any given period, if you've done any trading in commodities, you know that they're highly volatile because there's some disagreement, way more volatile than stocks from minute to minute, from day to day because of that disagreement. And that's what makes them speculations.
Yeah. And you could argue there's no inherent value that you can necessarily measure from a supply demand balance sheet. They're not growing, right? Gold is gold. It's just, it's a bet against, it doesn't have any intrinsic value other than maybe some marginal industrial value, but other than that, it's not really.
Right.
So one of the fundamental questions or issues people grapple with when they're investing, in my mind, is this idea of having a sound investment allocation policy, but then feeling or looking at the view from the ground, say interest rates right now, and saying, yeah, but this may be a sound investment policy. Yeah, but look at whether it's interest rate environments, how far the markets run, all those types of things. So in your experience, how much rope is reasonable to give yourself to lean to act on some of those valuation calls and leaning away from asset class and leaning towards other classes? Because you can give yourself a little bit of rope. Some people give themselves enough rope where they're in and out of different things altogether.
Well, I mean, it's a judgment call. And there's a couple of factors that influence that. One being, how much money do you have? And in the education side I run, having spent so many years working with institutions, trading costs were never an issue, or rebalancing costs. But for smaller clients, say, whatever, some starting out, but even, let's say, $100,000, making adjustments based on expectations or what's going on with the market, I mean, the cost of just the trading can have an impact. I think the other thing, though, is just the opportunity cost. And the way that I have invested over the years and the way that I teach investing is primarily buy and hold, long-term strategic allocation, but not a blind risk taker. And so where I do like to know what's going on, I don't want to be agnostic in terms of the market. I want to know if there's areas that are overvalued. And starting with the base that I can't predict the future. And so it's all risk management. It's playing the probabilities, trying to figure out, all right, given the current situation, where is there the most risk? And is the potential harm from that risk justify making a change? But the reality is all investing is active. Even if you're dyed-in-the-wool, purely passive, unless your allocation matches the global market portfolio, which is basically the weights of all investments based on how large they are, right? If you make any deviation at all in terms of how much you have in U.S. versus international, then you're making some active decisions. Your decision when to rebalance is an active decision. And so I'd rather make those type of adjustments based on where we are in terms of the market cycle, where we are in terms of valuations, where the economic trends are. Because what I'm looking for is regime changes. So you lived through 2008, and I lived through 2008 managing money. And I saw the absolute terror that clients had. And we should have made more adjustments, right? And so I think you can't predict the future, but the risks were there that advisors should have been adjusting their client portfolios.
Yeah,
we were adjusting ours, reducing risk, should have reduced them more, but there should have been adjustments made.
When I look back at that period and do a self-evaluation in terms of how I navigated it with clients, I grade myself okay on defending assets when things were falling apart. Now, not getting totally out of the way. There was no major call that I was some hero or anything. Joke, it's like, if the market goes down 20% and you go down 10%, that's a great job, but it sure doesn't feel like it.
Exactly. Right. And that's what we did, right? We didn't make money during that period.
Yeah. But the hard part, and where I grade myself lower is, and this is always the hard part of any kind of timing, is getting back in to when things ultimately turn. Because I remember in March of 2009, actually the bottom was my son's birthday in March 9th of 2009. Even as that big rally came from there, the messaging and literally the world still felt like it was falling apart a year or two after that, even though the markets were recovering. And that's part of the hard thing of doing this.
Well, it is. And that's where you have to look at, some of the survey data was improving from the economy. And you started, markets go in trends. And so once we hit maximum fear, you started to see a reversal of that. And that was time to tiptoe back in. If you reduce risk, you can't ever get the timing right. It's just not going to happen. Yeah. So you're just adjusting based on risk. And you could be stepping back in March, as we did, or even June. But we were early, right? We were early by emerging markets. We were starting to step back into emerging markets in December. And so it's hard. It really is hard.
Here's a question, because I think this is really important that, that a lot of advisors, I think, miss. That is that we're not dealing with institutional money. The type of process that is generally used by financial advisors is similar to the, rudimentary, but similar to the process you used in advising institutions, right? It's that prudent investment process, setting asset allocation, policy and rebalancing and everything else. The difference in my mind, and I'd be interested in your take on this, is that institutions don't die. Ultra high net worth investors have a multi-generational timeline, whereas normal people like you and I, we have a timeline that is much more compressed. And investing with that type of process where it assumes you don't die, it's not tied to the life goals that you actually care about, is very different than an institutional ultra high net worth that has a 100+ year time frame. How have you come to reconcile and make sure that those are tied together, whether it's for you or for how you talk to people?
Well, in my case, like the institutional, it's how you define risk. And they define risk as volatility, because that's traditional finance. And so is this allocation better because it's less volatile given its given level of return? And they define volatility as, will the portfolio generate enough return above inflation and spending to last forever? For individuals, risk is primarily losing money and running out of money. You certainly have to accumulate it. But and an example, so somebody sent me a question the other day because I have some models on my site. And my aggressive portfolio still has around 30% in fixed income. And his question is, well, that's not very aggressive. Why aren't you 100% stocks? Well, I'm not 100% stocks because, one, we live in a very, very risky world that's becoming more interconnected, and stocks can fall 60% or 70%. And that can completely undermine somebody's retirement. They can't afford to take that type of risk. And so I don't even use volatility anymore in terms of making an allocation. What I use is maximum drawdown. What is the worst case scenario? Knowing worst case can always be worse than that, but based on history, Now, this allocation, how much could it lose over an 18-month period? And what's how long would it typically take to recover those losses? To me, that's a much better way to define risk for an individual versus an institution where it's just volatility. Because volatility is both upside and downside. I don't care if we want upside volatility, right? If we're making more than expectations,
yeah, we
that's
all like
great.
that. Yeah, we like that part of the equation.
Right. But from an institution, that would also be considered bad because it deviated from expectations. Which
is something that a lot of us don't get in that, a lot of people, when they hire an active manager, whether it's a mutual fund or individually managed account, the assumption is that their job in the investor's mind, in the retail world especially, is they're there to make me money. And in reality, and you correct me if I'm wrong, by mandate, that's not their mandate. Their mandate is to hopefully beat in whatever matrix they decide the index that they are investing in, whether it's small cap growth or large cap growth or international. And generally, they're fairly tied to that index and they're all in because it's a relative game for them, not an absolute game like a lot of investors think.
Right, which is completely, unless somebody's a hedge fund,
right?
Yes, they're playing a relative game. And working with investment committees over the years, and I would tell them all the time, the only way an active manager can outperform a benchmark is by being different from that benchmark, which means taking very specific bets that generate tracking error, differ from the benchmark, which means periods of underperformance, because that's just how it works. You're going to have to suffer through. A top quartile manager will underperform their benchmark 30 to 40% of the time over a 3 to 5 year period. Consistently. And that's just how it works. And the problem is, as investors, we don't have the patience to wait out underperformance. Because, again, if the selection was made based on a book and a presentation, how do we know if the first 3 years they don't do so well relative to their benchmark? Let's say they're trailing by 1.5%. Is that because they're not skilled, or is it because their style is out of favor, or something else, something changed? So, which is why most investors are better served just not doing the active management game unless they truly understand the manager, or it's an area of the market that isn't effectively replicated with index funds.
In my mind, if you're going to use an active manager, then you use one that is not tied to a specific index so they can actually manage. So they're not...
Right.
But still, the bar is, and it goes back to that whole, how do you identify luck versus skill? It's not really as easy as you think.
Not at all. And I've met thousands of managers, and I ran a research group that's what we did, tried to find the most skilled managers. And you look at my portfolio now, it's primarily passive. I'll have a few active where I think they can add value. And example is high momentum, small cap, micro cap growth, right? Not a great ETF available in that asset class. So I'll use an active manager because it's somebody I know well, and that's fine. But it is very, very difficult to do. And it's very, very difficult to keep clients on board. So part of it's just the frustration. As an advisor, great, maybe I can pick them, but is my client going to stick around while they go through those periods of inevitable periods of underperformance?
Yeah, and Jeremy Grantham of GMO is a great example of this, who is I don't know if you're familiar with their story.
Oh, yeah. He's one of my favorite investors.
Hopefully
you're going to share his quote. I love his quote.
I'm not sure what quote you're referring to, so I'll tell a quick story and then you can use the quote. But right. You remember they were strict value investors have been forever, GMO, which is out of Boston, I believe. And during the tech boom, they would not deviate when a lot of value managers were creeping over to the growth side to keep clients. And I forget what they lost, but it was like over 50% of the assets they managed because clients were leaving them because they were sticking to their strategy, basically. So go with the quote,
from that experience, he says, ultimately, we were vindicated and we will outperform. It might not be with the same set of clients that we started with. Because they left, and I saw that. I mean, that was an amazing time. I remember going up to visit with the Oakmark family, because the family of mutual funds, the Oakmark Fund, and which you might be familiar with, and meeting with the head manager, Robert Sanborn, because he was going through the exact same thing. He was losing assets and he was sticking to his value discipline. And we were going to go up because we had a lot of money in that fund as well as separate accounts with Oakmark. We met him on a Friday. He pounded the table. He said, yeah, I'm in. I'm sticking with my discipline. And they fired him on Monday. And we took all our money out of that particular institution because they didn't have the fortitude to stick with their investment process and style. Not that you can't change over time, but the time to be making changes is not when PEs of stocks are at 45 or higher.
Yeah. So it goes to, even if you find the amazing manager and you happen to be right, or even the right, the asset classes, you have to, if you don't have that long-term perspective, you're not going to get the benefit of it because there are times when they're just not going to be doing well. And, we talk about, wow, if I would have invested in Amazon 10 years ago, whatever the number, I don't know if it was around 10 years ago, but nobody ever sticks around for that whole ride.
No, you don't have any insight what the future is going to be. Is this the year that Amazon falls apart, right? Because people want to take profits. We have psychological, our behavioral aspect is we want to lock in gains because then we can pat ourselves on the back because we're great investors. Whereas we don't want to lock in and sell losses because there's always a chance it'll come back. And so generally speaking, we hold on to our losses and sell our gains when we should actually be doing the opposite and letting our gains run and cut our losses when we don't know why. If we don't have a justification to continue to hold a particular investment, or we don't understand what's going on, then we should not be in it. We shouldn't continue to hold on to an investment because we think it might come back, and we would feel really bad if we actually sold and recognized the losses.
I feel like we could talk about a lot of different things in this area all day, and it's just so interesting. I want to make sure I'm respectful for your time, and we bring it back. So if you had one or two fundamental tenets that would help someone be an investor rather than a speculator or gamble, what would those be?
Well, I think one, focus on portfolios. So don't spend so much time isolating on specific investments. The idea is to build out a portfolio of diversified return drivers. So different things drive different returns. So what drives real estate is different than what drives bonds, which different than stocks. And it isn't so much the percentage, right? I mean, it does. As institutional, it's like, well, should we put 15.5% in this asset allocation or particular asset class or 17? It doesn't matter. The question is, get it diversified, understand and have some true investments based on our definitions, but you can have some speculations and focus on building out a diversified portfolio that way. And don't get caught in the weeds. Is this active manager better than this one? And be very wary in terms of things that is truly gambling. Great example of gambling. Well, I can give you some examples, right? For most of us, because we don't have any type of informational edge, commodities, trying to play specific commodities is gambling. Because generally speaking, if we don't have any type of insight, in fact, I talked to a trader that traded, like professional, like hedge fund trader in commodities. And basically, to be successful in trading commodities, you need order flow. You need access to see, what is the supply and demand situation for people placing orders. If you don't have that, that's gambling because the expected return is going to be negative. Or currency, oftentimes, for most of us, is gambling. For some, it's probably speculation because they have enough insight to what's going on. So when we get back to our definition, it often depends on what we know. For what professionals might be speculation, for the common person is gambling because people can take advantage of us. People that have some type of informational insight could take advantage of us, and so we have an expected negative return, and that's gambling.
Yeah, and that informational edge could have nothing to do with the actual supply demand or value of the asset. It could be just simply that order flow and the mechanisms of what's going on. So,
well, right, exactly.
You have fantastic resources on your site, moneyfortherestofus.com. I'll share links to those. David, always enjoy talking to you. Thank you for sharing your wisdom.
Yeah, we'll have to do it again. Thanks.
welcome to the Happy Lab, where we noodle on living a little bit happier life. Now, when I was young, we'll say 10-ish, we used to dress up in football pads that we bought from the Myers Thrifty Acres, which is like a Walmart, and we'd have these massive football games, and I would come home bruised and cut and scraped, and then the next day, I was excited to get out there again. Now, here I am, age 50, and you can guess where this is going, and I'm getting back into mountain biking. And recently, I was riding on a trail, and I was doing all the bypasses. So on a mountain bike trail, when there are technical areas, usually they'll give you a bypass so you can avoid the technical parts. And I was diligently avoiding the technical parts, not because I couldn't necessarily do them, but I was just getting back into cycling. I wanted to get my rhythm and find my balance on a mountain bike again, because it takes some time to build those skills back up. Well, I decided not to bypass a particular obstacle, which was basically this wood bridge going over this major stump. And it went up probably 4.5 feet, very steep, and then went down 4.5 feet, very steep. And, if you have enough momentum, usually it's not that difficult. Well, this time, got up, started to go down, would have had it fine, except there was this huge branch sticking out on the way down, and my right handlebar caught it, which turned my wheel, which caused me to fly over my bike and fall 3 or 4 times. And yeah, I scraped my knee, and I think I put that down on Facebook and had some friends talk about it, but it was really my shoulder that was much more scraped and bruised up. And I get home, my wife looks at me, shakes her head, and says, "Why do you do that?" Now, the next time I was out on the trail, I come up to the same obstacle, and I do the bypass. And you're probably thinking, "Yeah, that's pretty smart, Roger." But here's my thought. I'm like, Roger, you can't do that. Just because you're getting older doesn't mean you don't moderate what you're doing, but just because you're getting older, you can't be afraid to fall down. Because what happens is, as we get older, is we get hurt or we fall down, and then we go in our house and we stop doing. I'm not saying don't moderate your activity to where you're at physically, but don't ever stop doing, because that's the spice of life and that's what will make you happy.
On your marks, get set.
Hey, welcome to the Smart Sprint segment, where we set a little baby step for you to take in the next 7 days to create a great retirement. So what I want you to do is gather all of your investment assets, all these statements or spreadsheets or whatever you have, so you can view them each week as we go through this multi-episode of building a process and a strategy to not accumulate assets. Not that we don't want some accumulation, but to start thinking about how to build a process to make these assets, this wealth, work for you so you can have the retirement that you want. So the first step is we got to get all the information. So get all your investment account statements or spreadsheets organized so you can start to look at them and compare as we go through this multi-episode extravaganza on investing. Hey, I want to thank you so much for joining me today on the show. Now, if you are ready to start mapping out how you're going to retire, or really dialing in how you're managing your retirement, and you feel like you need an expert in that area, go to rogerwhitney.com, click on Work with Roger, and let's set up a time to talk. I can help you build that roadmap. I can help you walk that journey and identify the blind spots and create an action plan so you can make the most of the only life you have. So if you have an interest in that, go to rogerwhitney.com, click on Work with Roger. As always, this is one of my favorite times of the week, spending it with you. Until next week, this is Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.